Hey guys, I want to give a shout out to my friend Mary. I also have a sister named Mary, but I have a friend named Mary who has invested in Target, and I'm wishing her luck. I hope I'm wrong for her sake. Um, but we'll see. We'll see next week. We got big box earnings, retail sales, Fed minutes, what to know this week. The state of the U.S. consumer will take center stage in the week ahead as quarterly results from America's premier big box retailers in the July retail sales report highlight the calendar. Home Depot, Target, Walmart lead in earnings calendar also includes TJX, Ross Stores, and John Deere. The July retail sales report is due out Tuesday morning, while the minutes from the Fed Reserve July meeting will be released Wednesday afternoon. Yahoo Finance will also feature a week-long special, Retail Evolution, the New Era. Um, Last week, Consumer Price Index reports show a headline: inflation's rapid cooldown took a pause in July, rising 3.2% last month after increasing 3% in June. But economists came away from the report focused on monthly price increases remaining low for the second straight month. Um, so yeah, my guess, and I might be wrong, but I do not like I do not like the big retailers right now. You got homelessness everywhere. You got drugs everywhere. You got people going into Walmart and they're taking the buying $300 TVs and they're changing the stickers to $1. Um, I don't know. I'll have to do some research, but I'm not really sure why Target took a big hit a while back. I think maybe they did or said something like political. I don't know if it was gay rights or what they did, but anyway, like as you can see, if you believe it's going back to 259 sometime in the future, holding this at 131 right now is probably a good bet. I mean, maybe I don't know how many years it's going to take to get back to 259, but to plunge from you know 261 down to 131, that's quite a big jump. If I'm just looking at this thing from a PE ratio, even though it dropped over $100 a share, it basically dropped in half. It dropped $130 a share. The P ratio is still 22. So what does that tell me? It's going to take me 22 years to get my money back before I start making any profit. A P ratio of 20 is basically a 5% return. There's 20 nickels in a dollar. So that's easy to. You can do the inverse. 1 divided by 20 it's 5%. Now, the earnings per share is $5.86. Um, so you're paying for every $5.86 you invest today, you can expect $1 1 year from now. Let me say that again. For every $5.86 you invest today, you can expect $1 1 year from now. Now their dividend is very healthy at 3.31%. So out of that $5.86 of earnings per share, they basically gave back $4.34 in dividends, which to me is a little concerning, because if you're only earning $5.86 per share and then you're giving $4.34 back to the investor, you're not paying down debt. You're not buying back shares. You're not reinvesting in the company. I mean, if you're paying out basically $4.34 out of $5.86 that you earned, that leaves very little wiggle room to reinvest in the business. And ideally, as a dividend investor, yeah, it's good to see a good amount of money being returned to the consumer, but you also want to see them, are they paying down the debt? Are they reinvesting in the business? Let's see if we can see what sometimes you will get some very knowledgeable investors on here that are multimillionaires that actually know what they're talking about. So my advice to my friend, and I told her this, and is, even though it's, if you're holding long term, yes, I do think, when a company drops in half like this, but you can see this was a bubble. This right here was a bubble. You basically go from 83 all the way to 261. That's a bubble. That's not real. It's real in that it happened, but it's not. To me, it doesn't mean the company is worth this much. Because up here, that would mean that you could buy the whole company for $120 billion, and it's at $60 billion right now. So according to the balance sheet, their assets are basically 50 billion, 53 billion in assets. Let's just say 50 billion assets. All right, there's 20 billion in debt. So what does that mean? Well, what's 50 minus 20? 50 billion in assets minus 20 billion in debt. That means the net assets, to me, just peeking at this thing, is 30 billion, right? Total assets, total debt. 50 billion in assets, 20 billion in debt. So what's 50 minus 20? That's 30 billion, right? And the company's trading at 60 billion. So the company is trading at basically double the assets. Now let's look at the income statement. They got 109 billion in revenue. The cost of revenue is 82 billion, and their gross profit is 26 billion dollars. But you can see their year-over-year earnings per share basically dropped more than half, from $14 a share to $6. And we want to look at the diluted. So the net the net income, this is profit. So I mean, this is profit up here too, but this is the real profit. Net income, profit, and then you got to divide this by how many shares there are, and which comes, I guess, to $5.98. You take 2,780,000 and divide by how many shares outstanding, which I think we saw shit. So it'll be like 460,000 shares. No, these are in thousands. So these are 460 million shares. Hopefully I'm telling you this right. Like I said, guys, I'm not a financial expert. I'm just, I like to read quarterly reports, annual reports. I like to look at statistics and based on stuff that like Benjamin Graham looked at, net assets and cash and there might be undervalued assets that are not priced on the balance sheet accurately, like in the case of Sears as far as real estate goes, where you had bought an acre of land 100 years ago for probably $50, and then fast forward 100 years and that same piece of land now is worth $1 million, and that's not accounted for on the balance sheet. The only thing they account for is what it was when they bought it. And the same thing when I was talking about when you look at Berkshire Hathaway, for example, is they might have bought Apple at $30, and now it's $200. But anyway, I'm getting on a tangent. All right, they got $2 billion in cash position. Beginning cash position, in cash position. So their cash position ain't too good. Now, why do you say that, Alex? When Bill Gates ran Microsoft, he wanted to be able to pay all of his employees for at least 1 year if they had no income. So, just like the average person, you should have, depending on your situation, if your job is steady, maybe you just need an extra week's income, or in case you get sick or something 1 week. But if you're like in travel nursing, like I am, I might be out of work for months. I might be in between contracts for months. So me, I like to keep a little extra to be able to survive and be able to pay my bills for months, if not years at a time, in case something happens. Now, the good news I would say is, looks like they bought back some of their own shares, because as you see here, in 2021 they had 500 million shares outstanding. So let's just say, let's look at a pizza box, and let's say that pizza box has 500 slices and every slice is 1 million shares. Now we've gone down to 470. Now we're going down to 460. So obviously the management must think that this company is undervalued. Because they are buying back shares. But in my personal opinion, only having $2 billion in cash laying around is not enough. When you had a market cap of $120 billion, you could buy the whole company today for 120. What was it, last year or whatever it was, early this year, a couple of years ago, 2 years ago, for 120 billion. So you have, let's say you're the owner, and so you got a $120 billion company, and you only got $2 billion cash. That worries me right there. There are 28 analysts covering Target right now. I guess this is the estimated earnings per share average. This is the low estimate. This is the high estimate. This is the year ago's earnings per share. They're guessing they're going to have earnings per share for the quarter of $1.43. Here's the revenue estimate. They're estimating $25 billion in revenue. The low estimate is 24. The high estimate is 26. Here's the earnings history. The estimated was 72 cents. The actual was 39 cents. And that was a negative 50% surprise. And that was probably one reason the stock fell 100%. It fell 50%, I mean. But what people don't realize is when the stock falls 50%, you have to have 100% gain to get to break even. So the stock falls 50%. To get back to where you were, you need 100% gain. And here's all the recommendations. We got 3 to say sell. No, I don't know if that's anybody. Maybe it's nobody says sell. Maybe that's 3 says underperform, 18 says hold, 0 say buy, and 26 say strong buy. And recommended rating is a 2.4. Raymond James has downgraded it. Oppenheimer, outperformed. Jefferies, buy to buy. Wells Fargo, equal weight to equal weight. Telsley Advisory Group, outperformed. Barclays, equal weight to equal weight. These guys don't know what the hell they're doing or what the hell they're talking about. What's interesting to me is Bank of America owns 2% of Target. Wells Fargo owns 2%. Vanguard owns 10%. You know, when you buy a VOO or something like that, the SP 500, that's Vanguard. Um, Here's the Vanguard 500 Index Fund, Total Stock Market Index Fund. And these two really closely correlate to each other. This is the total stock market, this is just the biggest 500 companies. But yeah, I didn't know Bank of America and Wells Fargo got a position in Target. BlackRock, 7%. BlackRock basically owns the world. I don't know. I wouldn't say that, but they got a lot of interest. It's a big hedge fund. 81% is held by institutions. Now this kind of worries when I see something like this. Um, it kind of worries me, and here's why. Um, you don't have someone like Warren Buffett owning 50%. That's never going to sell. So you know the floor. If Warren Buffett says owns 50% of Target, and he's never going to sell ever, you know that the price can never go below half, right? Because you know they're never going to sell. If you got, let's say Sam Walton, for example, of Walmart, you know, and they own half of the shares or whatever, you know they're never going to sell. So the price could never go below 50 because they're never selling. So there's only 50% of the shares up for grabs. Here, you have institutions owning 81% of the shares. This guy right here looks like he just sold 3,748 shares on May 17th, 2023. Now, that's not a lot of shares, but it worries me when the insiders are selling. Now, all these other ones, this says stock award. So these shares are like part of their salary. So like they didn't buy them, they got them free as a gift for being in the company. But this guy actually sold. So this guy, Matthew Legal, I don't know what his role in the company is. But he sold last time too, so maybe he just selling it for, there's only an extra $200,000. So he just sold it for the $235,000, and he sold it last year for $213,000. All right now. Are you starting to panic now? Look at this. Don Leo on April 3rd sold between 165 to 167 and the tune of $2 million. Brian Cornell, officer and director. Don't this make you sick, guys, how much money these guys make? Back when manufacturing started, the difference between the average worker and the CEO was maybe 10 times. I mean, I went to college the same as this other guy. I mean, why should this guy get $6 million? He went to the same school I went to. He didn't go more years. His grades probably weren't any better, but yet they're going to pay just because, pay the guy an extra $5 or $6 million. So here we have another sale. A $2 million sale. Now that's a lot bigger deal than 200,000. Here we got an officer and director. I'm not sure what his what that means, but he sold $505 million worth. March 14th, 2023. This is recent, guys. This is not that long ago. And see, they didn't buy anything. They got all this stuff for free. They just got awarded stock. They didn't buy anything. They just got it. Hey, you're an officer. I'll just give you, all these shares for free. John Mulligan. He sold last year almost 3.6 million. He sold 6 million in September. So, all right, this guy basically, it looks like he bought $6 million worth between 139 and 141, and then sold at 163 to 168. This guy made some dough. He sold I don't like it how it doesn't tell you if they bought or sold. But this to me looks like he sold at this price for 20 million. And then he bought at this price. And then looks like he bought again. I don't know. That's confusing to me. Um, so this company has, when you buy a share, you basically have $3 cash per share. The book value per share is $25. The income is 2.7 billion. The PE is 22, but the next year's PE is 13. That's actually good. The price per sale is good. The price per book is bad. It's trading at 5 times. This price per free cash flow, that looks really high, which is not good. It says earnings per share this year is negative 57%, and earnings next year should go up 22%. Return on assets 5%. That's not good. Return on equity 24%. Return on investment 11%. Gross margin 24%. Operating margin, profit margin 2.50. And see, like, I do not like that. If you're a dividend investor and you're looking to hold this company for the next 40 years, this is bad. This is bad right here, for me. My opinion. Like I said, I'm not a financial advisor. I never went to school for any of this stuff. I just an average guy that just spent watched a couple YouTube videos and read a couple books. But this company is paying out 70% of their income in dividends. So let's say that, I think I'm going to hold this company for the next 20 years, and I think they're going to increase their dividend every single year for the next 20 years or 30 years or 40 years. Think again, guys. They're already paying 70% of their income out in dividends. When the companies that I got for my Roth, basically their payout ratio is around 20%. So they're only paying about 20% of their profits out in dividends. Now, when you see something like 70%, I would think of a company like Coca-Cola, who I'm curious now. The payout ratio, look at that. I mean, what a fucking lucky guess. They're paying 73% of their income out in dividends, Coca-Cola is. But Coca-Cola is an old company. But and look at Coca-Cola's profit margin. Their gross margin is almost 60%. Their operating margin is 26%. Their profit margin is 23%. Well, they're paying out 63% of their income in dividends. But look at their profit margin, 23%. Let's go back to Target. Profit margin, 2.50. I mean, that could be wiped out if gas prices go up a little bit. I mean, if somebody sneezes, that could go away. I do not feel safe sleeping in my pillow at night when the company that you have invested in has only a 2% profit margin. Let's go to Walmart. Well, look, Walmart's even worse. Their profit margin is 1.8. And their payout ratio is a little less. They're only paying 54% out in payout ratio. And Walmart's been around a lot longer than Target has. Insider transactions, negative 80%. All right, the insider transactions for Target are only negative 5%. That's better than Walmart's. And here are some, these are what the big banks are, downgrade, 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 downgrade. Why Target is a great dividend stock. They're paying 70% of their income in dividends, dum-dum. Four big analyst cuts. Target losing top-line momentum. Target downgraded. Target stock gets hit with a 1-2 punch. 3 reasons for the double downgrade. Here's why Target declined in Q2. Target sued by investor over backlash to LGBTQ merchandise. It didn't take me to the article, did it? Buy Walmart on cash flow, sell Target on inventory. A lot of shorts meant a lot of money right here. Guys, I don't know about you, but this right here worries me. You know why? And granted, I haven't looked at the 10K. I haven't dug deep in this company. I'm just taking 5 minutes to look at it. I just don't like retailers from a macro point of view right now. Um, this guy right here, guess what he is? He's the CEO. He's in charge of the company. And what's he doing? Looks like he sold at 245 to 246 to make a $6 million profit. Then he got gifted 200,000 shares. He sold 30,000 shares to get $7 million. He got some more more shares as a gift. More shares as a gift. Then he sold for another $6 million. He got some more free shares. He got some more free shares. He got some more free shares, and he sold it. I don't know if he's buying. No, I guess this was a buy because he had 79,000 shares, and then he got 35,000, and then he's got 99. I don't know, but it looks like he sold here, sold here, sold here. I would guess because the price was really high. I know for a fact these two have to be sales. I would assume that this is a sale as well. Um, I'm not sure if this is a buy or a sell. Um, See, like right here, it tells you whether it's a sell or a buy. You know, if you got a chief executive, director, a chief financial officer, you know, that's selling, that's not good news. That's not a good sign. But to me, this looks like he sold there, sold there, sold there. Um, I mean, if you got the CEO of a company that doesn't believe in the company, uh, that's not good. Let's see what the chief financial officer does. I don't see anyone specifically called the chief financial officer, chief executive officer. That's the CEO. Okay, he's the VP and the chief financial officer. So Michael Fin- Findical. Findical. Michael Finnical. Finnical. Looks like he sold at 210. But why did all the bigwigs sell when this thing went up to super high? Because they knew that this company was not worth that much. They knew that this was an artificial price. That this price wasn't real. This was a fantasy. I mean, yeah, maybe 5 years from now, 10 years from now, maybe this height will be reached again. But according to just the brief time I've looked at the insiders and what they're doing, you got to think the CEO, the company, the chief financial officer, they're the ones that are going to know what is going on with their company. At least they should know. And if you see that they're selling, and these aren't little small amounts of money. I mean, you saw the guy's salary is only like $1 million, but yet they're selling 5, 6, 7, $8 million worth of stock. That tells me that they don't believe in this company. So you got Matthew Legito selling number of shares of the units to be sold 1,459 of the tune of $234,000. Now these numbers are in millions, and this is also unaudited. Net earnings is right here. That's $950 million. Now, for a company that his market cap was $120 billion, okay, they almost made a billion a quarter. So if they make $1 billion a quarter profit, I mean that's $4 billion a year. But the market cap 70 billion. So you're basically, if you bought the whole company for say 70 billion, you can expect 4 billion in earnings, maybe. Total current assets. Total assets. This is similar to what Yahoo was saying. Total current liabilities. We did not repurchase any of the shares. This right here, to me, it sounds very dangerous. Warren Buffett has said derivatives are basically weapons of mass destruction. Now I'll repeat that again. Derivatives are basically weapons of mass destruction. Um, Derivatives can be very dangerous. It says, first, we fully invest in opportunities to profitably grow our business, create sustainable long-term value, and maintain our current operations and assets. Second, we maintain a competitive quarterly dividend and seek to grow it annually. And finally, we return any excess cash to shareholders by repurchasing shares with the limits of our credit rating goals. Well, they got that backwards because we already seen Finviz has told us that they are paying out 70, that's a 7-0, they're paying 70% of their earnings through dividends. So as you can see right here, the earnings per share, if you own one share, if you bought one share of Target for $131.05 on August 11th, your earnings per share for the year would have been $5.86. And out of that $5.86, $4.34 is a dividend. So there's not much to reinvest in the business. It says, ranked in order of importance. First, we will invest in opportunities to profitably grow our business, sustainable long-term value, and maintain our current operations and assets. Second, we maintain, and then they're talking about share buybacks. But to me, it's the other way around. I mean, if 70% of your earnings are going to dividends, how are you investing in the business? All right, so they invested $1 in the business and then returned $4 to the shareholder. I might be wrong, guys, but I think that it's going to be bad news. I'll let you guys read this one for yourselves. Get your popcorn ready for Wednesday. And then this comment. Huge pool party here. Michelob Ultra is flowing. Happy weekend longs, and no women anywhere. But I saw some news the other day in China, and basically, China is suffering deflation. What does that mean? that means instead of inflation, instead of prices going up, the price is actually going down. And I expect that to happen here as well at some point. Well, that was a long video, guys, but yeah. Um, home in Minneapolis, Minnesota. But as you can see here, I mean, they had 106 billion in revenues last year, which gave them 7 billion in earnings. 2021, 93 billion, which turned into 4 billion in earnings. 78 billion, which turned into 3 billion. But then, bam, 109 billion in revenue, but the earnings are only 2.7. I'm not sure where this ESG. Well, I hope I'm wrong for my friend's sake. Um, and not to discourage her, I do think, in the long run, I think at some point in the future it will get back to those peaks, but I think it's going to take a while. I think it's going to take years. there's just so much uncertainty right now. I think we had this big fire in Hawaii. We got Russia and Ukraine still fighting. We got North Korea shooting off missiles again. I hate to scare anybody, but we could be in a world war at any moment. Around the world there was $40 trillion basically printed by the governments around the world. And to me, in order to find true equilibrium, $40 trillion has to be destroyed in some way, shape, or form. Because the market has basically been puffed up out of thin air just by money printing, and the Fed, honestly, they're just better off just doing nothing, because every time they do something, they screw it up, and the market will correct itself automatically. And usually, whatever the Fed does, it messes with things. But anyway, guys, thanks for listening. That's all I got to say on Target. I wish my friend luck this week. My advice to her would be to sell, and then you can rebuy it, once the prices fall, because basically there's an earnings estimate, and if they meet or beat their earnings estimate, that's good news. If they miss their target by half, where here they missed it by over $1, they missed it down here by almost half. I think it's going to be down here somewhere. I think they're going to be a miss, and there's also, like, you missed on top line, or you hit the top line but you missed on revenue. So there's two different factors that are really key in whether a stock goes up or goes down. I will say one thing that people may not be aware of, and I mentioned this, I think, in another video, but in October, we're in August right now. October, guess what happens? People have to start paying student loans again. The U.S. owes $1.7 trillion in student loans, and credit cards just hit an all-time high of $1 trillion in credit card debt in the U.S. So people can't even pay their student loans. They can't even pay the minimum payment. They're stretched thin as it is. Rents has gone up, food has gone up, gas has gone up. And for anybody who's on the lower end of the socioeconomic status, they have to pay a higher percentage of their income in rent or mortgages. They have to pay a higher percentage of, as far as food and gas, and then you got people that were already struggling, that are living off of ramen noodles, now have to pay a student loan, go back to paying student loans again. And then we got Christmas right around the corner. I think it's going to be bad news. I do. I mean, you had that little pin-up demand after COVID because people were getting checks in the mail. They were getting play money being sent to them for sitting at home on their butts, and they couldn't go anywhere for months and months and months. So they had all this money built up, and then they went on a spending spree. And they basically blew all that play money that they had, and then now the interest rates go up, the inflation goes up, and that quote quote free money wasn't really free, was it? The first rule in economics is there is no such thing as a free lunch. You may think you're getting something for free, but somebody's paying for it. And if you're not working, somebody is paying for you. And unless you're disabled or mentally handicapped in some way, shape, or form, most people in this country expect other individuals to work for a living. They don't expect them to get handouts and get a free pass. They're working their ass off every day, going to work and earning a living by hard work, and then you got other people that just want to be bums and sit on the side of the road and beg for money and ride around in Range Rovers and stuff and sit on the corner and pretend that you're homeless and prey on the people that give them money for not working. I hate to mention a Bible verse in the middle of a video here on finance, but I'll tell you, I'll give you a little nugget. There's a verse in the Bible, and it goes something like this: like, if you don't work, you don't eat. And eventually your stomach will start to get hungry, and you will go out and find something. You will go out and find a job because your stomach hurts and you're hungry and you need something to eat. In this country, when Social Security first started, a lot of the people that were eligible for Social Security refused it because in their mind they didn't earn it. They were just given a handout, and a lot of people, they don't like handouts. No, I work for my money, and I work an honest living and an honest job, and I'm going to pay for me and my family and help out another family as well. I'm not going to be a burden to somebody else just because I want to be lazy and sit at home and do nothing all day. So, I mean, a lot of people might think that's kind of harsh by God. If you don't work, you don't eat. That's what it says. So maybe this sounds harsh to some people, but this we commanded you, that if any would not work, neither should he eat. We hear that some which walk among you disorderly, working not at all, but are busybodies. But yeah, anyway, we're going to have some earnings this week. It's either going to be good news or bad news. So stay strapped. I have a feeling it's going to be bad news, but people think it's going to be good news. They're going to make some money. The target estimate is 165, and it's at 131 right now. So if this 1 year target estimate is true, which I don't give any faith to, I mean, there's just too many variables. I mean, we don't know if an earthquake's going to hit tomorrow, or a hurricane, or a missile, or you just don't know. You can't forecast that when there's so many variables going on around the world. We got a 2% savings rate right now. It used to be 8%. We're down to 2%. We got student loan payments of $1.7 trillion due in October. We got $1 trillion of credit card debt. The country as a whole is over $30 trillion in debt. And that doesn't even include the unfunded liabilities. Social Security, Medicare, Medicaid, doesn't include pensions, firefighters, police, public servants. If you add all the unfunded liabilities together, we're probably $250 trillion in debt or more. I mean, over the last 20 years, this country has basically just gone into more debt and more debt and more debt and more debt and more debt. And I've already told you guys that for every $1 the government borrows, it only adds 18 cents to the GDP, gross domestic product. The U.S. economy is somewhere around $20 trillion a year. Maybe 30 trillion, somewhere in between 20 and 30 trillion. Alright, this is in millions, so this is in trillions. So for 2022, it was 25 trillion. But yeah, I mean, people just don't have the money right now. I mean, they're like I said, they're up to debt, up their tush, in credit card debt. They got student loans, they got car payments, they got either rent or mortgages. Companies are laying off people, so people are losing their jobs. They're having their hours cut. We got deflation happening right now in China, which is going to be coming over to the U.S. soon, in my opinion. Everyone was always talking about inflation, and I was always talking about deflation. So what does deflation mean? That means that you could buy more goods and services for less money. So what does that mean for a company like Target? That means that their profit margins are going to be shrinking, not going up. And as we saw on FinViz, the profit margin is 2%. So what happens if the deflation of 5%? Well, that means now the profit margins are now negative. There's no profit. Look here, this is the short interest. So this is the people that are betting that the stock's going to go down. That's what this short interest means. There's 9 million shares that are shorted right now out of 460 million shares. There's 9 million shorts. So not many, but Now, I don't want to scare anybody, but 2,400 stores are closing across the U.S. in 2023. Now, what does this say right here? Walmart. Now, what does Walmart do? They're in retail. Well, what does Target do? They're in retail. Oh, the ex-dividend date is August 15th, so you basically have to hold it through tomorrow to get the dividend. Me personally, it might be. I mean, if you think the prices, you think the stock is going to fall 10 or 15% on earnings news, it might be better to sell now or tomorrow. Or if you think it's going to go up, I guess just hold it, and then you're going to get your dividend. If you have 10 shares, you're going to have Probably close to a $50 dividend. But Bed Bath & Beyond goes bankrupt, followed by Foot Locker. Bed Bath & Beyond is closing 900 stores, Foot Locker 500 and some stores. Tuesday Morning, which I've never heard of, closing 500 stores. Walgreens, Christmas Tree, Bath and Body Works, The Gap and Banana Republic, Party Center, Walmart, 23 locations. Best Buy, another retailer, 20 stores. Lidl, 11 stores. Amazon, 9 stores. Big Lots, 7 stores. Real, 6 stores. Macy's, 4 stores. Target, 4 stores. Well, they said they're opening 20 new stores this year. I think that's bad. I think we need to hang on to our seatbelts, guys. We need to be building a cash position. I'm not saying don't stop investing, but I think that bad news is coming. I'm not talking about Target. I'm just talking about in the world. Our government basically told the Saudis, "Hey, you're going to produce more oil," and they basically say, "Hey, look, you don't tell us what to do." So, here we were energy independent a couple years ago. We were an energy exporter, and now we're having to beg and plead, please produce a little more oil for us. We gave all our strategic reserves to communist countries that do not like us, that are, there's ships military ships right outside our shores. There's spy planes right next to our borders. I don't know. I'm not the best Christian, but my opinion is, and nothing against anybody from a different nationality from myself, because God loves all His creatures and humans, and loves all His creation. But my viewpoint is, I think we're we're coming towards the end times here pretty soon, and there's going to be wars and rumors of wars, and so even though I love investing, I love studying companies, I love investing in companies. I think that we gotta be watchmen and watch and keep an eye open. Because I think the stock market should crash once every 7 years. The market has not crashed in a very long time, because every time should crash, basically we print money. Like in COVID, we increased the money supply 40%. Um, that's unheard of. And then you got other countries around the world that basically are trying to go back to the gold standard, and they're stockpiling gold, and they're trying to get away from the U.S. dollar, and they're not buying our bonds anymore. You know, the Chinese and other countries around the world were always buying our debt, buying our bonds. That's what bonds are. They're debt. They're debt instruments. Even the dollar bill is it's like a promise. It's like a promise to pay you later. You know, it's like, uh, but the paper itself is worthless. You know, it's where the world's currency, and right now. We still hold that right. But if we don't tighten our belt, we could lose that right, and a country that maybe does not like us very much might have control over the whole monetary system, uh, which would not be good for us. And the debt in the U.S. is so high right now that it's almost the biggest part of the budget, just paying the interest on the debt. I mean, you have normal households that have a fixed budget every month. They have to pay their rent, pay their mortgage. They have to put gas in the car to get to work. They have to put food on the table. They can't spend more money than they make. And people need to be saving 15, 25% for retirement, because Social Security, they say it's going to be there, but you can't trust that. Social Security was never meant to be a retirement. It was supposed to be a supplement to retirement. Um, we got to start taking our future into our own hands, guys. We can't allow the government to cradle us from take care of us from cradle to grave. You know, they have done a poor job at managing money. They have done a poor job at keeping promises. You know, most of the pension funds across this country are broke. Article: U.S. pension funds are on the brink of implosion, and Wall Street is ignoring it. Private equity firms managing millions of Americans' retirement savings may be inflating their investments. Don't take my word for it, guys. Pension funds report millions in losses amid Silicon Valley bank collapse. On and on and on and on. Pension crisis. Time bombs. the pension funds have to get 4%, and the problem is when the AAA bonds just got downgraded to AA not that long ago. Fitch Ratings downgraded its U.S. debt rate on Tuesday from the highest AAA rating to AA plus, citing a steady deterioration of standards of governance. The downgrade comes after lawmakers negotiated up until the last minute on a debt ceiling earlier this year, risking the nation's first default. Now, the pension funds, they can't just invest in any old thing they want to. A lot of them, they have to invest in, I believe, AAA bonds. And I may be mistaken on that, but if they own, say, AAA bonds, and they got the bonds they owned got downgraded, or whatever they own got downgraded, well, guess what? They can no longer hold those. They have to sell them at a loss, because is it going to be worth more or worth less? It's going to be worth less because to the pension funds they're worthless unless they're AAA. I don't know. I might be wrong, but I can guarantee you this: that there is around this country, the pension funds are broke in many states around this country already. They're just not telling you about it. They have to get 4%. They can't even get 4%, which is pitiful. I mean, you can't even get a 4% return on your money. I mean, what are you, stupid? I mean, that's pitiful. You can't even get a 4% return. But there's millions of people around this world, whether they're policemen, whether they're firefighters, whether they're teachers, whether they're whatever, that they've been promised these pensions, they've been promised this money for the rest of their life, and these pension funds are broke. What are we going to do? We're going to bail out the pension funds next. We're going to pay off $1.7 trillion in student loans. We're going to pay off $1 trillion in credit card things. The people don't realize this, but the banks are ripping you guys off. They're taking, an average person probably makes at least $1 million in a lifetime, probably a lot more, and you're basically giving 30% of it to the bank. When you buy a $500,000 house, you're paying $1.2 million for it. You're basically letting the bank buy 2 brand new houses with your money. And the first 15 years, you're basically just paying interest. You're not even paying on the principal of it. They're charging you 30% credit card fees. They're charging you $2 to use the ATM, and then when you if it ain't your bank, they charge you another $2 or $3. They got a fee for this and a fee for that, and when you buy a car, they're screwing you over there. You're paying $6,000 or $7,000 in interest. Again, to the bank or whoever you're getting the loan from, but the only way car dealerships make money is on financing, on ripping you off on interest rates, and we have to learn to live within our means. And, sometimes being rich is just being able to pay your bills and having a little bit left over. And, the rich people in this country, most of them, you don't even know who they are. You would never guess. They're the ones that look like bums. They're the ones that are driving the old car that barely runs. They're the ones that aren't flashing their money. They're the ones that you would just never know it. You would never know it. But they just save. They just live on less than. They have a budget. They have a plan. They live on less than they make, and they invest that little bit of money that they save, and slow and steady over a long period of time. Eventually, that money will work for you, and you don't have to go to a job to earn money. Your money will basically earn interest by itself and buy more and more shares. And but I mean, we're the richest country in the world, guys, and we got a bunch of broke people. And the purpose of this channel is to help educate the average investor to start investing, or if you are already investing, to get a better return on your money. I mean, I'm big on PE ratios. I'm big on price to book. That this is what's worked in the past. These are not great companies, but if you're buying a company at 2 times earnings, you're gonna get your money back in 2 years, assuming the company is profitable. If you're buying a company at 20% of book value, I mean, you got an 80% margin of safety there. If the company has more cash than the market cap of the entire business, which I've covered before, there was a newspaper company in Texas that had $30 million in cash, and the market cap of the company is $20 million. Now, granted, they had some debt, but assuming they had no debt, I mean, it sounds crazy, but you can still find these things today. So let's assume the company had no debt at all. They have $30 million in cash that you could buy the whole company for 20. You could buy the whole company and then just take the 30 million and walk out with a $10 million profit. But even the young investors that I see, they tend to go for the biggest companies, and which is fine, because even I said, I didn't say I like Apple. I said I like Google and Microsoft, ExxonMobil, Berkshire Hathaway, and the S&P 500 index. Oracle, things like that. But it'd be nice to go back 30 years and buy Nike at $1. Go buy Amazon at $3. Instead of buying the biggest companies, I think we need to put some of that money into new technologies and new businesses of the future. I mean, we know AI is going to be big. We know robotics is going to be big. We know space. Uh, there might be space mining. There might be space travel. There might be. I don't know. I think the 3/4 of the world is underwater in the ocean, and we have not studied almost none of the of our ocean. Um, so I mean, there's a lot of what's the internet going to be like? What's the cell phones going to look like in 20 years? Are we going to have our own robots? Um, what do you think? Is oil still going to be around in 20 years, 30 years? So, and if so, what's the price going to be? These are um, if maybe you invest, $1 into a app that's a new app or something that's trading for $1 right now, and maybe that app is going to be the next big app to take off. Um, I like to also invest in smaller companies because the reason is the smaller companies will hopefully in time grow to be big companies, and the companies that are big today, unless they reinvent themselves, kind of like Microsoft did, they eventually get old and die. Um, And basically, right now in the world, we basically have a lot of monopolies going around, where basically these big companies, if they see a smaller company coming into their space, they either will forcibly buy them out, or or keep them in court and send them a lot of frivolous lawsuits, or just buy them out. So we have to. I remember when the phone companies got split up. Um, we got Verizon today, AT&T. These were all one company at one time. The all the oil companies used to be one company. They got split up into seven or so different companies. Um, at some point, I mean, since we have a worldwide economy now, like those big companies still have someone to compete against in other countries, but not necessarily domestically someone to compete against. So a lot of these are monopolies, and any company that has a good idea that's coming up, they just get bought out. They get sent. They get caught up in litigation, and they just don't have the finances to withstand 5 or 10 years of constant litigation, and eventually cave in to the pressure. So, but if you could find the next Amazon, if you could find the next Google, if you could find the next Coca-Cola, I mean, and it's out here today. It's one of those stocks that are 50 cent or $1 or $2 or $10, and 40 years from now it might be $1,000 or $2,000 a share. So to me, that's exciting to find these diamonds in the rough that might one day be the next Google, the next Microsoft. But yeah, so I mean, I know people like big companies, but also you gotta look for the future, and think about some of the smaller companies. Imagine buying Coca-Cola at $1.50, and and today at, I don't know, 60 or $70 a share, and you're getting probably $3 in dividends every year, if not more. Anyway, guys, thanks for listening.